And we start to think about the relationship between what we have already done and what I'm presenting now, right now. If we have a more delay of payments with the suppliers, so we pay 90 days instead of 60 days. All other things without any change. Do we have an effect on the operating profitability or not? If we have a higher average payment to the suppliers, do you expect any effect on the operating profitability? So if we have a better working capital management, and working capital management is lower, has this lower working capital management has an effect on the profitability or not? And how? What is the mechanism? Any idea? If we have a higher average payment period, what is the effect on the net operating asset? Do we have an effect on the net operating asset if we have an higher average payment period? If we have a higher average payment period, the first effect is that the net working capital, we have more accounts payable. Having more accounts payable, we have a lower net working capital. I'm sorry, higher accounts payable, lower net working capital, lower net operating asset. If we have a lower net operating asset, we have a higher asset turnover, and we have an higher operating profitability. So the net working capital management has a direct effect on the operating profitability. When we manage net working capital, we have an effect on the profitability of the company. So lower net working capital, higher operating profitability. Higher net working capital, so less efficient in the management of the net working capital, we have a lower operating profitability. So if we increase the day on sales outstanding, if we increase this ratio, so we are paid in 90 days instead of 60 days, we have an effect on the operating profitability, and it is expected to decrease because the net operating asset is higher. At the same time, if when we are less efficient in managing the production process, so we have a higher level of inventories, again, the operating profitability will decrease. And this is the first level relationship that we have between the net working capital management and operating profitability. So when we manage net working capital, we have two different effects. The first effect is is on the operating cash flow, because as you remember, the operating cash flow, the cash flow from operations is the EBITDA minus the change in the net working capital, and this is the effect on the cash flow. And consequently, we have an effect also in the cash flow from operating activities. The second effect that we have when we manage net working capital is on the operating profitability. So when the net working capital increases, we have a negative effect on both cash flow from operations and operating profitability. The cash flow of operations decreases and operating profitability decreases as well. So this is why the management of the net working capital is so important, because it has effect on the operating profitability and therefore on the return on equity, and on the cash flow from operations. This is the overall profitability framework. So we start from the top, the return on equity. Then we decompose into the three different dimensions: the return on invested capital, the financial leverage multiplier, and the tax effect. The return on invested capital is decomposed again in the operating profit margin, so EBIT over sales, and then capital or asset turnover, sales over invested capital. Then we have the financial leverage multiplier decomposed in the financial structure ratio, financial leverage number 3 in our in our definition, and the financial cost ratio, the cost of debt. And then we have the tax effect on the end. When we talk about the invested capital, we have two different dimensions: the working capital requirement, the net working capital, and the fixed asset. And when we refer to the operating profit margin, we refer both on sales and operating costs. So this is the framework that we use to analyze profitability. And we use this framework. We can start from this picture and add here the ratios and dimensions that we have analyzed last week regarding the determinants of the working capital. So here we have the DSO, average payment period, days in inventories, and so the cash conversion cycle, referring to the working capital management. And here we have the different financial leverage ratios. This is the framework that we use to analyze a company. So how do we study this in the balance sheet and income statement? So when we study the return on invested capital, so EBIT over net operating asset, so we have profit margin times asset turnover, EBIT over sales times sales over net operating asset. Okay? So we break down the profit margin into the drivers. So this is why I use the when we reformulate the income statement, I use a different percentage. I use the percentage of each item in the income statement in relation to the sales. So if you look at the examples regarding the reformulation of the income statement, near each item, you have the percentage calculated on sales. And so we can study this element according to a longitudinal way. So we analyze the cost of goods sold in the last 3 years. And we see that the cost of goods sold decreases, for example, and this might represent a significant good effect, but it decreases with a lower level in relation to the decrease of sales. So before it was 73% of sales, now it is 77% of sales. So it decreases, but if we look at the impact that it has, it represents a lower level of efficiency, because before we have 73% of the cost of goods sold of the revenues, and now we have 77% in the cost of goods sold in relation to the revenues. So the first way to study this profitability is to look at the percentage composition of the income statement, and this is called common size analysis of the income statement. And to make possible to do this analysis, it is better if we reorganize the income statement items according to the destination. So cost of goods sold, research and development, sales and marketing, selling general and administrative expenses, etc., and not the nature. So not in relation to wages, salaries, rents, raw materials, etc. So it is the best way is to reorganize the items according to the destination. This is for the analysis of the profit margin drivers. So of this one, we study the relationship between operating costs and sales. The second dimension is the turnover drivers. The second dimension is we have already analyzed the determinants. So we can focus on the role of operating liabilities. When we have operating liabilities, we should consider also two different things. If we ask suppliers to be paid not in 30 days, but in 90 days or in 120 days, we have two effects. The first effect is that a higher level of operating liabilities increases the asset turnover, and so there is an increase in the return on invested capital. But if we ask suppliers to be paid in 120 days instead of 30, suppliers might charge us for a cost, because in some way they are financing the company. So we can have a higher level of operating costs, because instead of being paid 10% with a 5% discount for payment in 30 days, if we pay in 90 days, we have to pay the full price. So if we pay in 90 days, we have a cost of 95. If we pay in 100 days, we pay, if we pay in 90 days, we pay 100. So we have an increase in operating costs, so a decrease in the profit margin. So paying in 90 days, we have two opposite effects. The first effect is that we increase the asset turnover, because we have a lower level of net working capital, but at the same time, we have an increase in the cost, in operating cost, because we don't have the discount of 5% in this example. So as I told you, we should study and we should focus on the decrease or increase in the net operating asset. And in decrease of, when we study the decrease or increase of net operating asset, we focus on this. And when we focus on this, it is quite easy to manage, let me say, the determinants of net operating asset long term. Oh, we postpone an investment, for example. And this might be a problem, because if I am a manager and my bonus is based on the return on invested capital, I have a strong incentive to postpone the investments. Because if I invest, the net operating asset will increase, and because the investments have no short time effect, for example, in reducing the cost, for the first period, for the first year, for the first 2 years, I have a reduction in the return on investment, because I have increased the denominator of the formula, net operating asset, but these investments have not yet presented the effects on the EBIT. So I have an increase in the net working capital, and the EBIT tends to be equal. Also because if I have invested more, I have more amortization. So the EBIT is expected to be lower. So if we use the return on investment as a target for a manager, the undesired effect is to reduce the level of investment. And it might be good in the short term because you have a higher profitability, but it is the worst thing that you have to do in the long term. You can also have two different formulations regarding the return on invested capital. The pre-tax, and so you have the return on invested capital calculated on using the EBIT over the net operating asset, and the after tax, the return on invested capital calculated using the NOPAT over net operating asset. To reduce the risk of the underinvestment when we use the return on invested capital, some companies, for internal purposes, use EBITDA over net operating asset. So we focus on the operating profitability without considering the level of amortization. Now we focus on the last issue that I want to talk to you regarding the relationship between profitability and financial leverage. So there is the same company, and we have three different scenarios for this company: scenario 1, scenario 2, and scenario 3. And these three scenarios are different only for the financial structure. So in the first case, scenario 1, we have only equity. In scenario 2, we have 50% equity and 50% financial debt. In scenario 3, we have 25% equity and 75% net financial obligations. So we expect that above the EBIT, we have the same situation in the three scenarios. Because, as you remember, EBIT does not depend on the financial structure of the company. We have an interest rate of 5%, and a tax rate of 30%. So in scenario 1, we do not have any interest because we don't have any debt. So the earnings before taxes is equal to the EBIT. Then we have 30% taxes, and so we have earnings after taxes of 2,100. When we calculate the return on equity is 16.15%, and the return on invested capital is 23%. So the return on invested capital is the same for all scenarios, because the return on invested capital does not depend on the way the company is financed. Now we go to scenario number 2. Scenario number 2 is 50% equity and 50% net financial obligations. So we have to pay interest, 5% interest on the net financial obligations. So is 325. So we have earnings before taxes, and it is 2,675, so 3,000 minus 325. We have the 30% taxes on the earnings before taxes, so 803, and the earnings after taxes is 1,873. The return on equity now is 28.81%. That is earnings after taxes divided equity. So look, in the first scenario, we have the return on equity is 16%. In the second scenario, the only thing that we have changed is the percentage of net financial obligations over equity, so the presence of net financial obligations, and the return on equity almost doubled, 29%. The third scenario, we have the net financial obligations now that is 75%. So the same is regarding to equity. We have now interest of 488, 5% of the net financial obligations. Then we have the earnings before taxes, 2,513. Then we have taxes, and then we have earnings after taxes, 1,759. When we calculate the return on equity, we have the return on equity is 55%. So the three scenarios that are different only for the relationship between debt and equity presents the same level of return on invested capital and three different levels of return on equity. And this might be explained using this ratio, so the role of financial leverage multiplier, because the financial leverage multiplier has a positive effect, because we have an impact of the financial structure ratio, and the positive effect of the financial structure ratio is higher than the negative effect of the financial cost ratio. So do you remember when I explained this, I explained the fact that when we increase financial leverage, we have two different effects. One positive, that is the financial leverage, and one negative is the financial cost ratio. If we combine the two, we have an overall effect. When we combine the two effects, we have that the positive effect of the increase of financial leverage is higher than the negative effect of the increase of the financial cost ratio. Another way to represent this relationship between financial leverage and risk is using this formula. So it is the return on equity. For simplicity, we do not consider the 1 minus t when the t is the tax rate. So the return on equity is equal to the return on invested capital plus the difference between the return on invested capital minus the cost of debt times financial leverage, all is multiplied by 1 minus t. This is called spread. What is the meaning of this formula? If you want, you can try to demonstrate this formula, but it is quite simple but long, and it will be a waste of time for us. But take the formula as it is. So the relationship between the return on investment and the return on equity is the same. Is as follows. So the return on equity is equal to the return on investment plus the effect of the financial structure. So the return on equity, which is the overall profitability, depends on the operating profitability, this one, plus the financial effect. The financial effect is positive when we are able to invest our resources, obtaining a profitability higher than the cost. So the overall profitability will increase if we pay 5% as the cost of debt, but we are able to get more than 5% invested our financial resources. So if the return on investment is higher than the cost, we have a positive effect on the return on equity. And this positive effect depends on the amount of financial leverage. So if I have invested 1 million euro and I pay 5% of interest rate, if I get more than 5%, I have a positive effect on the return on equity. If I have a leverage of 10 million euro, and again, I receive 5%, I pay 5% for interest, and I get 7%, it means that I have a higher positive effect on the return on equity. So the relationship between risk and profitability is that if I have more risk, it is represented by the cost of debt. So having more risk, the first effect is that the spread will decrease. So when I have more debt, I have more financial leverage, and technically I should expect a higher cost of debt. So if I have in the situation 900 net financial obligations and 100 equity, I have a high financial leverage, and this might be a good for our overall profitability, but the effect is positive if I am able to invest this 1,000, obtaining a return higher than the cost of debt. So, is the financial leverage ever convenient? The answer is no, because it is convenient only when the spread is positive. And what is the link between risk and profitability? Well, the link between risk and profitability is that when we face higher risk, we have a higher cost of debt. And having a higher cost of debt, the effect on overall profitability is that the financial leverage is still positive, when the spread is still positive as well. When increasing the level of financial leverage, we have a higher risk represented in the cost of debt, and the spread turns to be negative, we have a negative effect on the return on equity. So we have here a summary of different ratios that we use in our decomposition. Again, summary of ratios again, and before ending this class, a clarification. So in chapter 6, or I don't remember the name of the chapter, in the chapter regarding these ratios in your Avanini Viale book, they have used a different definition of invested capital. If you remember, invested capital is defined as the net operating asset plus cash. And the invested capital for them is different from the net operating asset. Okay? So, what your book presents in terms of invested capital is affected by the inclusion of cash. So, when you analyze the ratios, you should consider that the definition of the ratios might be different, because what we call return on invested capital for them is the return of net operating asset plus cash. And what we define as the return on invested capital for them is the return on business asset. And business asset is our net operating asset. So, when we define return on invested capital, we refer to the return on business asset that for them is the EBIT divided by net working capital plus net fixed asset. So here, the return on capital employed, the return on invested capital, the return on net operating asset is equal to return on business asset because they have the same denominator. Capital employed, invested capital, business asset, return on net operating asset, they have the same denominator, that is the net operating asset. So this explanation, this clarification is necessary because otherwise you can find some misalignment with the book. Okay? So we have finished the first part of the course regarding the reformulation and definition of main financial ratios. On tomorrow, we will do some exercises regarding the profitability measures, etc. I asked to have with you the notebook because we will work on the Excel file for the Moncler case study. So tomorrow we will finish the reformulation of Moncler, the technical part, calculating the profitability ratios. Okay? And then we will make some exercises regarding the use of the profitability ratios. Again, I would remind you that on Friday, we have two options. The first option is if there are enough enough groups interested in discuss and share the problems that they are facing in the reformulation, we organize as a sort of Q&A class regarding the project work. So all are invited to attend because I can give you some hints and some suggestions for the project work. If I do not receive enough interest to organize this type of class, we will do a class as usual. So please send me today an email if you are interested in making me questions, and so we can organize this section on Friday. Otherwise, I organize the class as usual without discussing the project work. I will send you an email tomorrow when I have collected all the email for the interests to discuss the problems in the project work today. So if we have enough groups, I will organize the Q&A section. Otherwise, the usual class. The residual earnings. So there are two questions. The first question is from Luigi. Will the next part of the course, the residual earnings model, a part of the exam of the 2nd of December the 2nd? In the next part, we have two different subparts. The first is the residual earnings, and the second is the residual operating income. So the residual earnings is part of the exam on the 2nd, and the residual operating income is not part. So the first part, the residual earnings, is part of the model and of the exam, while the residual operating income is not part of the exam. Is it clear, Luigi? And there is another question from Giuseppe. In his group, there are only 3 students. You can manage the work in 3 students. I will consider that you are 3 in evaluation of the work. But if you are 3, there are no problems. If you are 2, it might be a problem. So for groups formed by 3 students, I do not see any problem. And if there is a group composed by 2 students only, you should talk with me. Okay? Perfect. Other questions? Otherwise, we will see you tomorrow, as usual, for the in-presence class. Okay, see you tomorrow at 10:15 and at 10 and 12:30. See you. Bye-bye.
Professor,